We are told again and again that our financial system is stable, resilient, and well managed. Yet history has a habit of interrupting comforting stories with uncomfortable facts. Today is one of those moments. A major bank has failed, not because of a natural disaster, not because of a sudden war, but because the system it operates in is designed to reward risk, privatize profit, and socialize loss. This is not an accident, this is a pattern. Let us begin with a simple truth that is often buried under technical language. Banks do not fail suddenly. They fail slowly, quietly, and then all at once. For months, sometimes years, warning signs are visible to those willing to look. Excess leverage, fragile balance sheets, dependence on speculative markets, and exposure to volatile assets. When liquidity dries up, the mask comes off. What we are witnessing is not a surprise, it is a revelation. Bank liquidations are often presented to the public as sudden shocks, unexpected events caused by bad management or extraordinary circumstances. This framing is misleading. In reality, liquidation is not an anomaly within modern financial systems. It is a predictable outcome of how those systems are structured. Banks operate in an environment that rewards aggressive leverage, short-term profit maximization, and risk-taking that is disconnected from the real economy. Over time, this creates institutions that appear stable on the surface while accumulating vulnerabilities beneath. The core issue lies in leverage. Banks routinely lend and invest multiples of their actual capital, relying on continuous liquidity and market confidence to function as long as asset prices rise and funding remains cheap. This structure looks efficient, even brilliant, but here is the first uncomfortable hook. A system that only works in good times is not a stable system. The moment volatility increases or confidence weakens, leverage stops being a tool and becomes a weapon against the institution itself. Liquidity adds another layer of fragility. Modern banks do not hold large reserves of cash. They hold promises, claims on assets that assume markets will always be open and counterparties will always perform. This works until it doesn't. And when liquidity tightens, those promises are tested. And when many institutions rush to convert paper claims into real money at the same time, markets freeze. What follows is not a mystery, but a chain reaction. Falling asset values, margin calls, forced selling, and ultimately liquidation. Here is a second hook worth confronting. Liquidation is not a failure of discipline. It is a system enforcing its own rules too late. Regulators often see the risks, investors often sense the imbalance, and executives often understand the exposure. Yet the incentives push everyone forward. No one wants to be the first to slow down while profits are still flowing. Risk is tolerated, even celebrated, until it can no longer be hidden. Speculation accelerates this process. When banks shift away from traditional lending toward trading derivatives and commodity exposure, their balance sheets become more sensitive to market swings. Gains are magnified during expansions, but losses are magnified even faster during contractions. The hook here is simple and unsettling. The same strategies that generate record profits also engineer record collapses. When liquidation finally occurs, it appears dramatic, but it is merely the visible end of a long structural process. The institution does not collapse because something went wrong yesterday. It collapses because the system encouraged it to operate on the edge for years. In this sense, liquidation is not a surprise event. It is the predictable resolution of a model built on excessive risk, fragile trust, and permanent optimism in an inherently unstable financial environment. Over the past several decades, the financial system has undergone a profound transformation, one that has quietly but decisively altered the purpose of banking itself. Banks were once primarily institutions that channeled savings into productive investment factories, infrastructure, small businesses, and wages that sustained long-term economic growth today. That function has been steadily displaced by financialization, a process in which profit is increasingly generated not through production, but through trading, speculation, and the manipulation of financial assets. This shift is not cosmetic. It changes how the entire economy behaves. The first hook is this. When finance stops serving production, it begins feeding on itself. Instead of evaluating loans based on their contribution to real output, banks prioritize speed, scale, and yield. Trading desks grow faster than lending departments. Complex instruments replace long-term investment. The result is an economy where money circulates rapidly within financial markets while real economic activity, job creation, wage growth, and industrial development lags behind. Low interest rates and abundant liquidity have intensified this pattern. When returns in a productive economy are slow and more uncertain, financial engineering becomes more attractive. Share buybacks, derivatives, commodity speculation, and leveraged positions offer higher short-term returns than building factories or funding innovation. The hook here is uncomfortable. Profits rise even as the underlying economy weakens. Financial success becomes increasingly detached from social and productive outcomes. This detachment creates systemic risk. Speculative activities depend on continuous market confidence and stable pricing. They assume that assets can always be sold, rolled over, or hedged. But speculation does not create new value. It redistributes claims on existing value. When too many institutions pursue the same strategies, markets become crowded and fragile. A small shock can trigger large losses, not because fundamentals collapsed overnight, but because the financial structure was never anchored in real economic activity to begin with. Another critical hook emerges when we examine inequality. Financialization concentrates wealth among those with access to capital markets while leaving workers and small producers increasingly exposed. As banks prioritize financial returns over productive lending, wages stagnate, job security erodes, and household debt expands to compensate for the lack of income growth. The economy appears active, yet it is being propped up by borrowing rather than genuine expansion. Over time, this imbalance undermines stability. An economy dominated by financial speculation requires constant intervention. To prevent collapse, rate cuts, liquidity injections, emergency facilities, these measures do not resolve the underlying problem, they postpone its consequences. The more finance replaces production, the more dependent the system becomes on artificial support. What emerges is a paradox that defines modern capitalism: unprecedented financial sophistication coexisting with increasing economic fragility, where the pursuit of profit no longer builds the future, but mortgages it. The sharp movements in silver prices are often dismissed as routine market volatility. Yet this interpretation overlooks what silver historically represents within the global financial system. Silver is not merely an industrial metal or a speculative asset, it is a monetary signal. When its price accelerates under conditions of stress, it reflects something deeper than supply and demand. It reflects confidence, or more precisely, the erosion of it. The first hook to grasp is this: market do not rush towards silver because they are optimistic about the future. They do so because they are uncertain about the promises embedded in paper finance. What makes the silver signal especially powerful is its timing. It reacts faster than policy, faster than regulation, and often faster than public awareness. By the time silver prices surge decisively, confidence has already begun to fracture beneath the surface. The spike does not cause the crisis. It exposes it. It is the market's way of whispering what official narratives are still denying: that trust in paper systems is thinning, and that financial stability rests on assumptions that may no longer hold. Thus, liquidity is often described as the lifeblood of modern finance, yet it is also one of its most misunderstood elements. In stable periods, liquidity appears abundant, almost automatic, giving the impression that markets can absorb any shock. This illusion persists because liquidity is not tested during calm conditions. It is tested when fear enters the system. The first hook is simple but unsettling. Institutions do not discover their weaknesses during booms. They discover them when liquidity disappears. Banks structure their balance sheets around the assumption that funding will always be available. Short-term borrowing is used to finance long-term assets, and market access is treated as a constant rather than a privilege. As long as confidence remains intact, this model appears efficient. But liquidity is not a resource stored in vaults. It is a relationship based on trust. When trust weakens, liquidity vanishes with surprising speed. Here is where balance sheet weaknesses are exposed. Assets that once appeared stable are suddenly marked down. Collateral that was accepted without question is revalued. Counterparties demand higher margins or withdraw entirely. What looked like a temporary funding issue quickly becomes a solvency concern. The hook here is critical. A liquidity problem and a solvency problem are often indistinguishable in real time, and markets rarely wait for clarification. Stress reveals the asymmetry embedded in financial structures. Banks may hold assets that are theoretically valuable, but those assets cannot always be sold without significant losses. In liquid markets, prices are forgiving. In stressed markets, they are brutal. Forced selling accelerates declines, creating a feedback loop that erodes capital and confidence simultaneously. What begins as a liquidity squeeze becomes a self-reinforcing spiral. Another hook emerges in the behavior of institutions themselves. When liquidity tightens, coordination breaks down. Each institution acts to protect its own position, pulling back credit and hoarding cash. Rational behavior at the individual level becomes destructive at the systemic level. The very mechanisms designed to manage risk end up amplifying it. Central bank intervention often masks these weaknesses, but it does not eliminate them. Emergency facilities and liquidity injections stabilize markets temporarily, yet they also signal distress. Markets read these actions as confirmation that something is wrong. Confidence may return, but only partially, and often unevenly. What liquidity crises ultimately reveal is not a sudden failure of assets, but a chronic dependence on continuous funding and stable perception. Balance sheets built on leverage and optimistic valuations cannot withstand prolonged stress. The disappearance of liquidity acts like a spotlight, illuminating risks that were always present but conveniently ignored. In that moment, financial strength is no longer defined by reported assets, but by the ability to endure when trust is withdrawn, and market confronts demand reality instead of reassurance. When financial institutions collapse, the language used to describe the aftermath is carefully chosen. Losses are framed as unfortunate but necessary. Bailouts are described as stabilizing measures. And public sacrifice is presented as the price of avoiding something worse. Beneath this language lies a persistent and deeply embedded pattern. Risk is absorbed by society, while rewards remain concentrated in private hands. The first hook is unavoidable. This outcome is not a deviation from the system. It is one of its defining features. In periods of expansion, profits generated by banks and financial firms are treated as evidence of innovation and efficiency. Executives are rewarded, shareholders benefit, and institutions grow larger and more influential. Risk-taking is encouraged, often celebrated, because gains are immediate and visible. Yet the structure of accountability remains asymmetric when those risks materialize into losses. The burden shifts away from those who made the decisions and toward those who depend on financial stability for their livelihoods. This shift occurs through multiple channels. Depositors face restricted access to their funds. Pension funds suffer asset write-downs that translate into reduced retirement security. Small businesses lose credit lines, forcing layoffs and closures. Public finances are strained as governments step in to prevent broader collapse. The hook here is stark. The costs of financial failure are dispersed across society, while the benefits of financial success are narrowly concentrated. The justification for this arrangement rests on the argument of systemic importance. Large institutions are portrayed as too interconnected to fail, their collapse framed as a threat to the entire economy. This logic creates a moral hazard. Knowing failure will trigger intervention. Institutions are incentivized to take greater risks. The system effectively ensures private behavior with public resources, without extending public control over decision-making. Another hook emerges when examining timing. Losses are immediate and tangible for ordinary people. While accountability is delayed, diluted, or entirely absent, investigations take years. Reforms are promised, but gradually weakened. Meanwhile, financial activity resumes, often under the same incentive structures that produced the crisis. The cycle continues, reinforced by the absence of meaningful consequences. This dynamic reshapes public trust. When workers are told to accept austerity, after crises they did not cause, confidence in institutions erodes. Economic rules begin to appear selective rather than universal. Markets are no longer seen as neutral mechanisms, but as systems that protect power and privilege. What makes this pattern particularly destabilizing is its cumulative effect. Each crisis transfers more risk onto the public, while allowing private financial structures to grow more complex and opaque. Over time, society becomes the ultimate backstop for a system it does not control, absorbing losses not as an emergency measure, but as a recurring obligation embedded in the design of modern finance. But financial crises are frequently described as rare disruptions, unexpected deviations from an otherwise well-functioning system. This framing serves a purpose. It preserves the belief that stability is the norm and collapse is the exception, yet history tells a different story. When examined over time, crises appear not as anomalies, but as recurring episodes produced by the internal logic of the system itself. The first hook is revealing. If breakdowns happen repeatedly under different conditions and with different actors, they are not accidents, they are structural outcomes. The modern financial system is built on expansion. Credit must grow, returns must increase, and markets must continually absorb more debt. This growth imperative creates pressure to relax standards, increase leverage, and invent new instruments capable of sustaining profitability when traditional avenues slow. Each cycle begins with innovation, framed as efficiency, and ends with instability, framed as surprise. The pattern repeats with striking consistency. Regulatory responses often reinforce this cycle rather than break it. After each crisis, reforms are introduced, but they tend to address symptoms rather than underlying incentives. Rules are gradually softened under the argument of competitiveness and growth. Memory fades, risk tolerance rises, and the same dynamics re-emerge in new forms. The hook here is subtle but powerful. Stability breeds the confidence that eventually destroys it. Another layer of recurrence lies in the disconnect between finance and production. When financial returns outpace growth in the real economy, speculative behavior becomes rational within the system's own logic. Asset bubbles form not because participants are irrational, but because they are responding to incentives that reward short-term performance. The system becomes increasingly sensitive to shocks, yet increasingly resistant to reform. Central banks play a paradoxical role in this process. Their interventions prevent immediate collapse, but they also extend the life of fragile structures. Low interest rates, liquidity support, and asset purchases stabilize markets while encouraging further risk-taking. The hook is unavoidable. Each rescue makes the next crisis more complex and more difficult to contain. What transforms these episodes from isolated failures into systemic features is the absence of structural change. Leverage remains high. Financial institutions remain large and interconnected. The profit remains decoupled from social value. Without altering these foundations, crises are postponed, not prevented. The recurrence of financial breakdowns is therefore not a mystery awaiting better prediction models. It is a consequence of a system that prioritizes expansion over resilience and private return over collective stability. Each cycle reinforces the same lesson, quietly and insistently, that without fundamental reform, instability is not a temporary phase but a permanent condition embedded in the architecture of modern finance. So let us be clear in our conclusion. This bank did not fail because of silver alone. Silver was the stress test, not the cause. The failure comes from a system that prioritizes short-term profit over long-term stability, speculation over production, and private gain over public responsibility. The real question is not whether more banks will face liquidation. The real question is how. Many times society is willing to absorb these shocks before demanding structural change. Until the financial system is reorganized to serve the real economy, workers, communities, and productive investment, these crises will continue, not as anomalies, but as features. And when the next spike comes, whether in silver, bonds, or currencies, we should not ask, how did this happen? We should ask, why did we allow it to happen again?